Welcome to another wrap for Friday, 27th of October. This week has found us in the middle of AGM season. Two notable meetings were Supercheap Retail Group, the owner of Supercheap Auto, BCF, Rays and Rebel Sport on Monday, and Apollo Tourism and Leisure on Wednesday. In terms of Supercheap, our analyst Jo Little retains her ad recommendation following the trading update, which was broadly in line with her expectations and her belief that consensus EBIT forecasts are readily achievable. And Apollo provided a timely reminder of the strong forward visibility within the rental businesses and potential further growth options that lie ahead. In the banking sector, the strong seasonality of the share prices of the major four banks continued as the first of the results were revealed on Thursday with ANZ Banking's full-year numbers. For the past 5 years, the Big Four have returned an average of 14.7% from the end of October through to the ex-dividend dates in November. 2012 was an exceptionally strong period, returning 28.9%, but stripping that out, the average return for the past 5 years has over this October-November period been 11%. Coming up, National Australia Bank posts their full-year result on the 2nd of November, followed by Westpac on the 6th of November, and CBA hosts their AGM on the 16th of November. As always, please note that comments in this video are general in nature, and please speak to your Edward Street advisor if you wish to know if any of the stock recommendations suit your personal needs and objectives. I'll now pass over to Cam for his macro summary.
Thanks, Brad. This week we saw the brakes being put on our market after the recent strong run that Matt spoke about last week. The ASX 200 is now trading just over 5,900 points as we edge closer towards 6,000 points. Our market has had a positive close the last 13 of 15 trading sessions, and we'll look to see if the positive momentum can be maintained and break a key resistance level at 6,000 points. At the risk of sounding like a broken record, the Dow Jones continued its run to new all-time highs during the week, nearing 23,500 points. US markets are largely being driven by earnings, whereby the likes of Caterpillar, McDonald's and General Motors all exceeded expectations during the week, renewing a focus on corporate America. It was a huge week for US earnings, and the results have so far confirmed the strength of the US economy, as well as stronger global growth. With the market trading at all-time highs, earnings had to impress investors to justify trading on a lofty price-earnings multiple. The major commodities remain largely unchanged this week, with oil and gold slightly advancing, whilst copper and iron ore came in a touch weaker. The Aussie dollar has continued its downward trend, buying 76.5 cents against the greenback. Domestically, we've seen a number of AGMs and quarterly updates, which will continue to drive our markets over the next couple of weeks. ANZ, as Brad alluded to, was the first of three major banks to report their full-year results, which showed cash earnings of 6.9 billion Australian dollars. This was a slight miss to consensus expectations, and we'll wait to see if there's any flow on to NAB and Westpac, which report on November the 2nd and the 6th of November respectively. The infant formula space has also been sought after for investors this week and holds the hot money. The likes of A2 Milk, Bellamy's, Bubs and Model Health remain the sought after investments, and is worth keeping an eye on this for high risk appetites. Cheers, Brad.
Thanks, Cam. For a bit of a change, on my left we have Tristan Elholm, who will run through his key buy for this week. Tristan?
Thanks, Brad. The stock I'd like to talk about today is the retail stalwart Myer, ticker code MYR. This isn't a stock that Morgan's Research formally covers. However, I think it's topical based on the amount of news this company is generating at the moment. Myer, like all other bricks and mortar retailers, is under pressure because of the Amazon effect. This has been reflected in the share price, which has dropped from as high as $1.39 this year down to 78 cents yesterday. A new CEO, new strategy and recalcitrant major shareholder would normally make this stock uninvestable. However, when the major shareholder is Solomon Lew, the retailing legend, the plot thickens. Solomon Lew has made a fortune over the years by being able to buy retail assets cheaply and improve their returns. He is agitating for a seat at the board of Myer, and should he get it, I'd expect a similar result here. This could yield excellent returns for those that are willing to back him. The price to earnings ratio for Myer is 8 times, which is cheap. The company has a strong balance sheet, and the historical dividend yield is 6.4%, fully franked. For those investors with a higher risk tolerance, I believe all the bad news is factored into Myer's share price, and the reward now outweighs the risk. I'm a happy buyer under 80 cents and would look to the upcoming annual general meeting and strategy day for further guidance on how the company is tracking. Thanks, Brad.
Thanks, Tristan. On the subject of AGMs, next week we'll have Reliance Worldwide on Monday and to round off the month, Bendigo Bank and Michael Hill Jewellers on Tuesday. That's it for another wrap. Please feel free to share this video with your colleagues and friends, and make sure you like the Morgans Edward Street Stockbroking Facebook page. Also, subscribe to the YouTube channel below. Have a great weekend, and we'll see you next week.